Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Hey everyone, it's March 27th, 2022. My name's Artie. I'm here with Gamma. Markets on a tear this last week. S&P year to date only down 4.69% now. NASDAQ down 9.68%. Russell down 7.34%. Dow Jones down 4.07%. All indices are still bearish trend on our model, and we're still in stagflation, still a very heavy stagflation.
If you want to play it simple, just buy and hold SPY. That's the best advice I could give you. If you don't really care and you're good for 20, 30 years, say kind of just fuck it. Buy SPY and close your computer down and walk away. That's your best bet. But if you want to be a little bit more involved with your investments and you want to try and build a better portfolio over time, we have a system that will tell you what to do when to do it, which is what we're doing. Now, obviously, there's going to be inconvenience or inconvenient positions throughout regimes and regime pivots and whatnot, right? You're going to get caught on the wrong side of a trade here and there. That's fine. Long term, though, the way we position our risk management procedures are when risk is on, we're very leveraged and we understand where risk is on and when risk is off. So by us understanding where risk is on and off to, we could stay very leveraged for a long time or as long as we need to be and capture as much alpha as we need to capture. So when times like this come around and we chop around and we're not like, we're never going to be hitting 1,000%, 2,000% option plays because that's not in our wheelhouse. That's not something we want to do. We're looking long term, multi-month, multi-quarter durations, not something that, no weeklies. You understand? So if we know our models work the way that they work, we're going to position ourselves to make alpha over the long term. Now, right now, you know, we have 40 something percent cash. We're going to chop around. It's going to happen. We're basically waiting. We're sitting on our hands. And I think that sums up what you're trying to say, that when a risk on regime comes, it's game time. Like you're going to see us positioned very aggressively to the upside. And the reason we're not doing that right now is it's quite obvious. If you've listened and paid attention to what we're saying, our models aren't telling us to do that. When our models tell us to do that, it's full steam ahead. But until then, we're going to play it safe because over time our models work, and like it doesn't make sense to front run the model when the model front runs the market, if that makes sense.
Yeah. We really make it free for everyone. But don't think that undermines it. Our models literally predict risk on and risk off situations. I feel like a lot of people don't quite grasp how much that means. But it's pretty wild. So
Yeah,
you guys
yeah.
should follow along because it's like just wait till the next risk on regime.
We're currently at a 75.1% system strength on stagflation. It's down from the almost 85, or not almost, an 85% rating at the beginning of the month. But the stagflation odds haven't shifted too much. We're only looking at a 60 basis point shift, which means the risk has been diversifying on the other regimes as deflation and inflation odds have been shifting around. Um, we have seen a sell off in bonds, which is being talked about on Twitter, and we've seen a bounce, as you said already, in the S&P 500. So let's go over the economic calendar for the upcoming week. We'll just read off the most important news events that are marked as market moving indicators. We have international trade in goods on Monday at 8:30 a.m. On Tuesday, we have the Case Shiller Home Price Index, which is basically the American average price, or I should say, the American Home Price Index, which shows us where home prices are, and it's something that is what is seen upon with the economy, where home prices are going. Obviously, housing leads, or I should say, housing is a major input in the economy because if house prices slide, um, everyone's individual finances are on the downturn. Then we have consumer confidence at 10 a.m. on Tuesday as well, and the JOLTS report at 10 a.m. on Tuesday as well. Then on Wednesday, we have a slew of things from the ADP employment report, the GDP, and then every Wednesday we get the EIA petroleum status report, which is basically our oil reserves report. On Thursday, we have jobless claims and personal income, and then Chicago PMI. Jobless claims and personal income are at 8:30 a.m. and then Chicago PMI is at 9:45 a.m. And then finally on Friday, which is going to be April 1st, we have the employment situation, which is our employment report at 8:30 a.m., PMI manufacturing at 9:45 a.m., ISM manufacturing at 10 a.m., and then construction spending at 10 a.m. So before we dive into the topics, let's go over the market structure over the past couple of weeks. We missed the podcast last week, or we skipped last week. So a lot has happened since our last podcast. The most important thing being the market rallying off the last FOMC meeting, where we were printing as low as 4100s or 4150s on ES, now moving all the way up to 4520. If you follow us on Twitter, you've probably seen our Twitter threads and our constant short term sentiment tweets. And what that is referring to is the price direction on a short time frame or short term sentiment. And what that is intraday, or I should say, multi day swings. This is not something that is long term. As you know, the long term sentiment is bearish on across all the indexes. Our DDAP trend is printing bearish trends on every one of them. And the short term sentiment is a bit more complicated for those that have the DDAP subscription. You want to kind of disregard the trend signals in the background because the time frame is so compressed. The more important thing is to focus on where Momo is, because Momo is more of an accurate indicator of where price is going to stop and pivot from and to. So
Wait,
back
hold on. Before you continue, do you want to explain what your setup here is with DDAP?
Yeah, so all I have is I have DDAP enabled on a 15-minute and on two 15-minute time frames. One of them is ETH, or extended trading hours, and the other is RTH, which is regular trading hours. And what this does is we try to simplify the trading session into the most liquid hours on one side, which is going to be regular trading hours between 9:30 and 4:15 on ES. And then we're going to want to have a full view of what's going on extended trading hours, which goes from 6 p.m. to 5 p.m. every day, Monday through Friday, I should say Sunday through Friday. Um, the ETH view is more of the now and or the current time frame, and the RTH view is the more bigger time frame within the shorter term, if that makes sense. So the short term, like I just said, is going to be with a swing lasting a couple of days. It's not something that's really trend significant on the longer term. More than more than 2 or 3 weeks. What we saw back in before, pretty much actually, I think it was the day before Powell came out and started speaking. We had we broke above ES 42, I think it was 4210s. We tweeted this in live in real time that if we broke above this level and held with our ETH Momo being breached first. Remember, on the way that this works is the time frames are broken down to ETH and RTH, and ETH is always going to have more realistic or more um close to priced Momo, meaning it's going to be much closer to the price because it's encompassing live data, which is not being imprinted in the RTH slot because the trading hours aren't. It's not regular trading hours. So the ETH Momo was lower than RTH, as you can see here. If you look at two charts, if you're watching, you'll see that ETH Momo was at roughly 4208, 4210s. RTH Momo was sitting at 42 70s. So that's roughly 60 points higher. So we noted this in real time that we noted this in real time that once we broke above here, we had the we had the chance of getting above our RTH Momo. Remember, if we break above ETH Momo and we're not above RTH Momo, we're pretty much going to chop, which is what you saw happen here. We pretty much chopped in here until we had the open here, which was all the way over here above RTH Momo. We opened up above and then we dipped. We tested RTH Momo and we kept going. We noted that this was the chance where sentiment remained extremely bearish. Short-term sentiment could flip bullish. We've been following the price action ever since, and obviously short-term price sentiment has remained bullish. So going into the new week here, what we're looking for is if what we're looking for here is for if a sentiment short-term sentiment were to change, uh 45 13s, 45 15s would probably have to be taken out, or I should say would have to be taken out before we can get to 44 85s. So anything under 45 15s will ping pong between 44 85s and 45 15s. If we do lose 44 85s, short-term sentiment will flip back to bearish. So in between 45 15 and 44 85 is going to be, I would call that the chop zone. Anything above 44 85 closing and significantly moving lower, like here, for example, this was end of day on March 23rd. Excuse me. Yes, March 23rd into the close of March 23rd. We closed slightly below Momo, and the next day gapped right back above on the RTH timeframe. This is not significant enough. We need price to stay under there and show strength moving below, which 44 85 is the key for short-term price sentiment. So now we will go into the rest of the story here. We had we have the FOMC meeting, an FOMC, excuse me, we have an FOMC meeting coming up on May 4th, 2022, and it has a 71.1% chance of a 50 basis point hike. And then the following meeting in June has a 63.2% chance of another 50 basis point hike. We have the Bloomberg implied number of rate hikes here, their rate hike modeling tool. And we're looking at 8 rate hikes into the end of the year, meaning simply that we're going to get one rate hike every meeting, with a few double hikes in between throughout the rest of the meetings at the end of the year. Remember, one rate hike is 25 basis points. So when I say a double rate hike, I'm referring to 50 basis points. And let's go to the next one being, we'll just cover this quickly because this is the consumer confidence index, which we had a report come out last week. It's reading 59.4. Quickly, we're at the rate of decline. We'll soon be at the 2009 lows, and if we go further, under 50, we will be under the 1980 lows. So that's something to watch. Obviously, this is a component of um, financial outlooks and people's understanding of the economy or where they think the economy is
Well,
going.
so how does that affect equity markets?
Well, this is consumer confidence where I think they test at least 500. They do like a 500-person survey. The minimum's 500 people, and they ask them what they think the short-term and long-term economic outputs are, or I should say, economic directions are of the economy, and what their personal financial situations are. So as this goes down, it's just confidence in the economy is going down, and people's personal situations are degrading as well, which makes sense with inflation ripping, right? Gas
Yeah,
prices
and
going up. So
I wonder if that also has to do with interest rates rising as well.
yeah, that's something we'll get into, but I'm sure it has an effect there. Obviously, rates go. More specifically, I think you're referring to mortgage rates, right?
Yeah,
They're
so
them going, yeah,
anyone that's a homeowner has a mortgage, they see rates rising, they're not going to have too much confidence in the future.
right. And it's more so people buying homes, right? Any new home buyers are gonna be discouraged because their price to own the same home is going up. And this is what I was talking about earlier with the calendar, with the Case Shiller Home Price Index. It's something we're going to want to watch because realistically, with rates going doing what they're doing, we should see a slide in home prices, or at least a top and a peak in home prices. But we'll
Mhm.
see. Obviously, weirder things have happened, right? But the higher rates go, the less a home is going to be. I mean, the home price index is, I think, up 20% year over year, right? And
Yeah.
rates are doubled, and
I
and
would
that's
say the whole reaction with home prices, the fact that home prices are up so much, I think is mostly due to inflation and the fact that there's not much space for people to park their money, right?
that's a
So,
good point. That's a
like,
good point, but
people need to put their money somewhere. If bonds aren't realistic,
right,
and they don't believe equity markets are going to be paying off, they buy real estate. So,
right. That's a good point. That's a good point, but you also have to remember that real estate, I mean, I get can we go here? We can go to you can look at the mortgage rate right here. So the mortgage rate, the average national United States mortgage rate was trading as low as 285 after the COVID pandemic. Well, I should say a year out, roughly 8 months after the COVID pandemic, or
mhm.
I
So
should
that
s what
that
was it?
just
That was the
drives
bottom. Yeah.
drives home
Now,
prices up.
yeah, so it didn't just drive home prices up. So there's a lot of issues going on with the economy right now. Like, not only did it drive home prices up, you had people doing crazy refis because it, you know, 2.85 or 3%, right? A refi, it's a steal. I mean,
Yeah, it's like
especially
free
those,
money. You're
yeah,
given free
yeah.
money.
Yeah, exactly, and especially those individuals who had pre-COVID mortgages up in the 4s, right? Getting it at 2.85, 3 is, a whole 1% cheaper, like, they're gonna do it.
Mhm.
I should say 100 basis points cheaper right off the note, but now we have rates back up to 4.5. This might be delayed. I think I saw this, it was closer to 5, to be honest with you. I think this reading the trading view spits out is delayed. Long story short, we're heading close to the November 18th peak.
Mhm.
At the rate of this move, like, I could see us getting back up to 5%.
Oh yeah, easily. But it's wild to think about how we were just there just 2 years ago. Like,
I know,
it's
it's
not even that big of
crazy.
a deal. Everyone's like, interest rates are rising, the economy's gonna collapse, the housing market's gonna collapse and everything. We were there 2 years ago. Like, it's wild to think about that. Has much changed in the last 2 years?
Yeah, inflation, right?
Yeah.
Inflation started accelerating. So, um, no, you have to remember there's two sides to this problem here. The United States mortgage rate I'm talking about. One is people buying mortgages, right? So, or I should say people taking out mortgages, which is basically it's like buying bonds, right?
Yeah.
You have people coming in and the supply is being taken out. So this can only go down so long before the supply comes in and it pushes it higher, right?
Mhm.
Or I should say the demand comes in and pushes it higher. There's no demand for mortgages right now, which is why you're seeing rates skyrocket. Number one. Number two, you're seeing rates skyrocket because the writer of the mortgage, the other side of the mortgage trade, the guy or the people who are putting the money up, they need to beat inflation because it wouldn't make sense to have a mortgage rate that gets eaten by inflation. I mean, there's going to be credit risk within the mortgage rate, right? You're going to have the ability, there's going to be a scenario of a default. So there's a credit risk there. So accounting for credit risk, you can't be negative against inflation. You understand?
Yeah. Well, like,
So,
why would they loan out the money if they're not even
right,
gonna be making money off the loan?
right. I mean, remember this is a 30-year loan, so let's look at the 30-year rate. The 30-year rate's at 2.6 right now, 260 basis points. So, you know, we do some we do some quick looking here. We're pretty much 200 or 190 basis points over the 30 year, which is makes sense that 190 basis points is default risk,
Yep.
right? So, I mean, I'm sure there are more. It's a bit more complicated than 190 basis points for default risk. Obviously, there's originations and stuff like that in there. But for the simple explanation, 190 basis points of housing risk, let's just say, right? So let's move on from consumer confidence. Let's go into VIX. We may have talked about this briefly in the other podcast, but I want to go into a little depth here with this because I think it's important that people understand what this is and how this works. So, um, v- VIX, like anything else, has futures contracts and they trade in expirations. So there's a current month and then there's a preceding month and then there's a preceding month all the way throughout the final expiration. Some things are monthly, some things are quarterly. It depends on the futures contract. So the first thing that you do is when you look at backwardation and contango, where let's start with backwardation. What does backwardation mean? Backwardation is basically when the current or now contract is priced higher than the future contract, the one next month or next quarter, with the next deviate, the next times, the next contract in that time series. If the current contract is priced above the next contract in that time series, it's considered backwardation. Whereas the opposite, contango, which is normal, is where the current contract is priced under the future contract. So when when we look at volatility, the number one thing that to look at is not so much the price of VIX, because if we look at VIX, VIX is trading at 20.8 right now. Uh, in history, it's bottomed. It used to bottom before COVID in the 9 or 10 area. We haven't really seen under, I think it was like 13, right? 14. We haven't seen under 14 since pre-COVID. So some people say like the new VIX low is 15 after from it being 10. Regardless, um, this is the volatility being priced into SPX options. Okay. That's what VIX is. So looking at VIX's face value does only so much because I could tell you VIX is 20 here. And if we go back to the 2019 to 2020 period, VIX 20 was market falling. Market was dipping hard. In the Yeah, in the 2018 end of year crash where the market fell 30%, VIX peaked at 35. We were at 35 for multiple days um, earlier this month. But it's not so much that some might say, "Oh, we hit 35, we hit 40, market bottomed." Not necessarily, because you have to realize in that 2018 crash, VIX came up from 11. Here, VIX came up from 20. That's the difference. But let's get off of VIX because it's not so important. What's more important is the spread between the futures contracts. And I'm going to scroll out here for those watching. You could see something that looks a bit weird. It's lines all over the place, and I'll even make this a line chart to make it simple. So you'll see these things like these lines moving across the zero line. What does this mean? When the value of VX, or this, we're using trading view here. So VX 2 1 minus VX2 exclamation point, excuse me, minus VX1 exclamation point is VX next month or next expiration minus VX current expiration. What this is showing you is the spread between the next and current expiration. When this is positive, the futures are in what we call contango. When this is negative, it's in what we call backwardation. So VIX futures up until the FOMC meeting were trading in backwardation for over a month. And after the FOMC meeting, you saw this straight breakaway higher, more of like panic buying, right? VIX kind of just shot up and went up I should say the spread shot up and went up every single day. Now, the key to watch here is when we get an equity sell off. Obviously, we're going to get some type of equity sell off. Right now, our models are positioned for stagflation, which is risk off, and historically, stagflation is usually followed by deflation. What we get this time, you know, we're not going to forecast the future. We'll let our models tell us in real time. And remember, our models tell us usually before a significant move happens. So it's almost as if it's forecasting, right? So when our model tells us we'll pivot, right now it's risk off, but no matter risk on or risk off, we're going to see an equity dip. The depth of that dip is yet known. When we see a dip, it's going to be important to watch what happens to VIX and the VIX future spreads. What for those watching and listening, this is really called term structure. I just don't want to confuse anyone. So I think we'll refer to that going forward. If I explain it, everyone will understand. So VIX term structure is basically the pricing of contracts from today's date going forward, today's expiration going forward. We focus on the next expiration and the current expiration, but the VIX term structure goes out a little further than that. So if the term structure on the VIX goes negative on an equity dip, that won't be good at all. It really won't be because it'll show us that this rally or this dip in equity was
Well,
on was of
do
go
you
ahead.
want to explain what backwardation means? Like, what does it imply?
Okay, so what it implies is people are bidding up volatility. I guess I'll explain this back with a definition. So remember, backwardation, it means that the current futures contract is priced higher than the next expiration, and what that is telling you is people are buying the futures contract now, not the one in the next expiration. Why would you do that? Why would you bid up volatility specifically now and then have it lower later? Well, you think volatility, it's exactly what it means. Volatility is going to be higher now than it is later, meaning there is more demand for volatility now than there is later, which is showing you that there's panic in the market. And if we look at the backwardation rate of the VIX term structure, you'll see that when there's real panic, this thing blows out. Like when I'm talking this thing, there's actual capitulation where people remember the backwardation is basically emphasizing that people are forced to buy protection, right? That you buy VIX futures because you need to buy protection and you need to buy protection now, not a month from now, not 2 months from now. You need to buy protection right now. It's kind of like um, VIX, right? If VIX is going to blow out, that when you see VIX rip like this and blow out, it's because people are buying protection now, and it's something that we've tweeted about a couple of times. Consensus likes to buy protection at the most inopportune times. They like to buy protection when when it's too late to be protected.
And when the protection is as expensive as it can be,
Right.
essentially.
Right. And that's when you see the VIX term structures blow out because what this is telling you is this is pure emotion. What this is pure emotion when like look at COVID. We went all the way down to negative 13. I think that's the lowest ever recorded on no, actually 2018 was 2018 was a bit deeper to negative
2008,
20.
you mean, right?
Excuse me. Yeah, 2008. Sorry. 2008, 2018. Yeah, joke. 2008 was all the way down to under negative 20, where 2020 COVID was negative 13, negative 14. 2000, we had some dips in between 2011, 2018, all of surpassed negative 5. And in between dips were, sub negative 2.5. If you had to draw a line of best fit, it would probably be at like 2, 2.5, 3. We barely got under 2 here. Does that means the market's going lower? No, not necessarily. That just means that there hasn't been capitulation. And if you look at the breakdown of the term structure, you can see it's almost like nice and smooth. Nice. There's no capitulation. There's no major what would I like to say gonging, right? There's no major blowout, which usually is seen even if it's a smaller blowout, it's something that happens within a couple of days. This took a month to go down, you know, 2
Yeah,
points.
it really seems like this pullback was like the calmest pullback I've ever seen.
Right. Yeah, I know. It's almost like methodical, right? Like it comes down, it bounces nice and slow or whatnot.
Yeah, yeah, everything just felt slow.
Right. And while we're on backwardation, I want to talk about crude oil backwardation because this is something that's actually, I think, people would understand here. This will explain the backwardation or the backwardation in contango scenario a bit simpler. So, oh, whoops. Here, let's see. Here we go. So we'll take DDAP off for this and we'll just draw a zero line for those. So those watching, nice and simple here. Okay. So this is the front month minus the current month on on crude oil. As you can see, this contract, or this, I should say, this term structure, this is not VIX, this is crude oil term structure, was trading positive all the way until January 2021. And then we kind of started petering with that line. We went from contango to backwardation to slight contango, backwardation, contango, backwardation, etc. Right? And we started grinding lower, which this is basically what this is. This is showing you is the demand for front month oil is constantly exceeding forward pricing, meaning that the price of the barrel of the oil contract this expiration is seeming to always outprice the barrel of the next expiration. Then we were trading in between 0 and -2 for months, and then we had the Ukraine thing, the whole Russia Ukraine situation. We basically doubled down to -4. It's important to note that the backwardation curve on crude oil is it shows it weakening to contango over time. So the backwardation is being the curve is constantly pricing in a reversion of this backwardation, and it's a matter of if we're going to see it or not. And if those using TradingView, if you want to look this up real simple, just type in the futures contract. So for crude oil, it's CL1 exclamation. This is going to be the current future, the current expiration, the front month. And if you scroll down on the right, you can see the forward curve. And what you're seeing here is backwardation. This is the definition of backwardation, where you have every month forward is constantly lower than the current month.
And so
Conta-
what does that mean? Does that mean oil prices are coming down?
Not necessarily. So it means that that the futures market is pricing in a drop in oil.
But that doesn't mean
But
it's gonna happen.
right, as I just showed you on the backwardation, or I should say the term structure curve for crude oil, it's been in backwardation since, January of 2021. The
So
backward
how do we use that information to make money?
It's not so this is not so much a trade base. This is more of understanding where, because obviously a lot of people are looking at energy trades, right? They're looking at commodities and stagflation. Remember, commodities are supposed to outperform.
Yeah.
But the backwardation curve on crude, let's bring that up again one more time. For those that don't know, crude oil is the number one, or the largest component of, or I should not say crude oil. The energy is the largest component of the commodities index. So if we have the backwardation, or I keep saying backwardation, the VIX, not the, the crude oil term structure here, this has been slowly grinding lower. Now, if we go back in time, let's see if we can see the low. We're really seeing the last time the lows were. I mean, let's go back. Let's see if we can go back all the way to 2008.
Well, so does it normally revert back to 0?
Yes, that's the thing. Over time, it does. Over
So
time. So I think that's what you're to answer your question more specifically, right? How do you make money? Long story short, this is going to trade in contango again. if that makes sense. What that means is this is going to trade above zero again.
Okay.
It
So
always does.
it's
It
mean
it always
reverting.
does.
Yeah.
Yes, it always does. Look, even in 2018 of June, it reverts. I mean, well, let's go back to 2013. It stayed in backwardation for a while. It reverts. It always reverts. The question is the time frame in which it reverts. So if it's going to revert, one of two things has to happen. It's a spread. Either the front month has to come down or the back month has to come up. But with the volatility around the crude sector right now, I don't think that you're going to see a significant change in this curve anytime soon. The Fed is also as you heard at the beginning, the is at least coming off as very aggressive. So that's not going to help commodities.
Yep.
I mean, in some ways, it could accelerate the backwardation curve to zero, it could accelerate the chance of a contango because it could kill oil prices up front, right, with rate hikes because commodities get crushed in rate hikes. You understand?
Yeah.
As rates go up, commodities are an inflation hedge, so as they kill inflation, commodities will come down. But it's really complicated. This is why we don't have a commodities position on because you have the Fed on one angle, but then you have another angle where you could make the viewpoint that commodities won't change anytime soon. There's too many supply chain disruptions, scarcities. We have a food shortage coming up. What's going to happen with commodities? They're not going to die off right away. They're going to have a bid. So it's kind
Wait,
of
hold on. You can't just mention we have a food shortage coming up.
yeah. I mean, I don't have the sources on hand to bring this
Well,
up right now,
I
but
know fertilizer prices are insane right
well,
now.
I mean, I think it's it was an MOS or MOM. So, what's it? Let's see. MO. There's a ticker. Is it MSauce? I don't no, I don't know the ticker. It's let's see if I type in fertilizer. No, I don't have a fertilizer company off the top of my hands here. They're going vertical. I'm not even gonna waste time looking it up.
Oh yeah.
If you want
Yeah,
to
they're
look up,
going
yeah,
vertical.
yeah. I was trying to show you guys a fertilizer company, but off the top of my head, I mean, I guess John Deere, right? John Deere isn't here. So the reason why this company's going up is they may have guided higher forward, but the idea that there's a food shortage, right? Fertilizer getting so expensive, it's going to be harder to produce food. Farmlands, and I don't know if you know this, but like people are seeking farmland, right? Um,
Yep.
and in turn, you need farming equipment,
You can look up
right?
MOS.
Oh, is it MOS? That's it.
That's a
That's it.
company, Mosaic company.
No. That's it. This is it. This is what I was thinking about. I don't know why I was doing MSOS, but this is it. This is a fertilizer company. Look
Yeah.
at it. I mean, we're talking in the last 1 month, it's up 60%. 3 months, 82%. Year to date, 82%. So obviously, there's going to be a food problem. I mean, this is quite apparent. Like
Yeah.
if
Stock
fertilizer
up.
is,
Everyone stock up.
yeah, and um, long story short, it's hard to play though because you buy general based commodities. You're talking oil. You're talking everything, right? Whereas something like corn could be, or excuse, I should say corn, right? Corn could be breaking down. We don't know. There might be a dip, but oil might not bode well. But food-based commodities may go higher. I should say foods, right? Agricultural might go higher where energy
hmm
lags.
Well,
It's
and
tough because
you're basically fighting the Fed as
that's
well.
my point. That's my point. That's why we haven't taken a commodities position because remember this though. This is very important. The reason why commodities are long in stagflation is because usually in stagflation and deflation, the Fed is cutting or the Fed's accommodative to the situation. We're in a situation right now where the Fed has to tighten. It hasn't been seen in over, I'd say 30 or 40
I
years,
think
right?
1994 was the last time it was seen.
Right. Now, it's also very important to note that in our models, we go back to the 90s, we haven't really encompassed the situation with our back tests here of stagflation, right? All these back tests don't really encompass a scenario where the Federal Reserve is acting against the economy where they're not being accommodative, I should say, right? It's accommodative. That's how you say it.
I think so.
Yeah, I think so. Whatever. Who gives a shit? Accommodative, right? So the Federal Reserve is doing what our back tests really haven't priced in. So we're very hesitant on how we're taking positions. We don't want to have the same exposure that we normally would because we believe that the situation is very unique. So it takes a little bit more caution in how we're positioned.
Yeah.
Um,
It takes a little bit more finesse. You have to really see
yeah,
what's going on around you because it's different from other stagflationary regimes.
right.
What was the like our model?
Well,
Pretty sure the longest stagflationary regime was just a few weeks prior to this
uh,
one.
I mean,
We never
you can
had
see it right here. I don't want to interrupt you, but you can see it. Those that are viewing, if you're not viewing, just go to market-radar.com, log in, sign up. This is all completely free, so you can just view it yourself on your free time. But those that are watching the video, take a look here at any highlighted orange sections. That's stagflation. And I'll let you continue. Already, go ahead.
well, yeah, I was just gonna mention that we've never had stagflation last longer than a few weeks or a few months.
That's a
And
good, yeah, that's
they
true.
always almost always lead to deflation.
Right, statistically, it's a deflation.
Yeah.
Statistically, going back in time, the stagflation leads to deflation since the GFC. It's not since the GFC. Our data goes back a little prior to the GFC.
Yeah,
Um,
to 2006. Unfortunately,
right.
we can't go farther back because a lot of the ETFs and asset classes didn't exist back then that our models are based off of.
Well, let me just make sure we stamp that correctly. The asset classes existed, but they weren't in tradable, trackable formats that we could plot for
Yeah.
you
Yeah.
here. So obviously, we tested back since 1990 on our regime data here, right? Since the first quarter of 90. But this data can't be portrayed into a SPY overlay because the data that we're tracking here is not available to be displayed in this manner, if that makes sense.
Yeah. So let's wrap it up here. Let's do a bottom line. What's the play right now? What can people do?
Okay, so let's just run through this real quick. I don't know how we're looking on time, but let's run through bonds real quick. So I know that this is a big thing that everyone's talking about, TLT, right? Everyone's like un getting absolutely destroyed. Remember, for our bond proxy, we like to use the bond futures, ZN, the 10-year T-note futures. As you can see, this is a much better trend, or I should say, view indicator or sentiment indicator, or however you want to word it, overall view of the bonds compared to TLT because it's just traded more liquid and it's you have much more pricing data over time. So we're a deep bearish trend here. I mean, a bounce is very possible. I mean, I mean, we're down year to date 6.89%. In the last month, we're down 6.98%. So just figure, in the last month, we're down in a straight line. A bounce is probable, but it's very important to understand what is going on here. So there's a lot of people that are talking about a bounce in bonds because of a peak in yields. And I think I have that chart right here. This is a little complicated. So those that are watching, I'll sum this up real quick. The blue line is the 10-year minus federal funds rate. So it's the 10-year treasury yield minus the current federal funds rate, which is 25 basis points right now. Now, let's take the green line, which is the break or the real yields on a 10-year basis, 10-year treasury real yields. We know those are negative. We expect them to go to 0 and above. That's our thesis. We've been talking about that a lot. And then the orange line is the 10-year treasury yield. So let's look at this from what consensus is looking at right now. Consensus is taking a trend line. Now, what they're doing is they're looking at the 10-year treasury on a basis like this. They're saying The long-term trend line is, well, they have a different trend line. That's really the real trend line, but they're looking at something like this. They're saying, okay, the 30-year trend line or whatnot is up here. We're close to it. We're going to peak, meaning the over the last 30 or 40 years, rates have been moving lower over time, and we're going to peak and we're going to go lower. Is it possible? Yeah, I mean, anything's possible, but also realize the last few times that we've got up to a level where rates have turned around, real yields have been positive. What that means, simply put, is that if you buy a 10-year bond right now, you are losing 50 or 40 something basis points. What's it right now? It is 45 basis points. You're losing 45 basis points every year, between 45 and 50. That's the current rate. Every time that this trend line has turned around from what we can see, real yields were positive. Because remember, for the trend to turn and prices or yields to come down and people to bid for bonds, they need a positive yield over time. Could this time be different? Maybe, but it wouldn't make sense for it to be. Meaning, if real yields go positive, right, the 10-year would be a lot higher than 2.47. And this is where the 10-year constant maturity minus federal funds rate, the blue line, is important because back in 2009 and 2014, this thing's traded at or above 3, meaning 300 basis the 10-year traded 300 basis points over the current federal funds rate. We're at 2, roughly 2 right now, meaning that the federal fund that the 10-year treasury could rally. I mean, this peaked multiple times since the 1980s at around 3.8 to 3.5. This thing could go up another 100 basis points, which at the current federal funds rate, even with a 50 basis point hike, would put the 10-year above 3%, which would get us back to pretty much the 2018 level. 10-year moves up like that, real yields go up too. We believe the real yields are going to go positive because there is so much negative. There was like, I think the number is $18 trillion in um, negative yielding debt in the last 12 months. And it's moved down to only like 3 trillion. So people are getting rid of negative yielding debt because it doesn't make sense if inflation is so high. So we're really watching real yields here. And long story short, that's our view on real yields going positive, and our potential push for higher yields is what gives us a bearish view on gold. Gold is bearish trend on our DDAP, but we don't think gold is going to just rip and break out. We believe it's more frustrating than anything. I mean, we do think that gold has the possibility of coming down to, Momo at 1840, no problem. But um,
Either coming down or just chopping.
yeah, it's not something you want to be a long conviction play until you see real yields peak. Real yields peaking, we believe, is above positive. We don't see why real yields would peak in the negatives. And remember, this is not the current treasury yield minus CPI or whatever. This is the current 10-year treasury minus the current 10-year break even rate. This is, you can find this yield on TradingView by typing DFI. Was it DFI 10? Yeah, it's DFII 10 on TradingView, which is by Fred. It is from the Federal Reserve. It's the 10-year Treasury inflation index security, constant maturity. So it's the 10-year minus the break-even rate, 10-year yield minus break-even rate. Right now, on Friday's close, it was negative 58. It's showing it's trading above negative 50 right now, but we'll see what that gets reported as tomorrow. And then one final thing while we're here, let's look at the high yield to S&P 500 ratio, or I should say comparison. This is the most important thing right now I would be paying attention to if you're long equities. So if you bought the dip and you had the testicular fortitude to go in there full size with your portfolio in a risk off regime, I give you credit,
Props to
honestly.
you. Props to
Yeah,
you if you did that.
props to you. How you bottom fished the bottom like that? Maybe you bought the Fed. You were like, Powell's gonna pump this shit, which he obviously did. Uh, you get, no love to the Bears, right? He just constant squeeze. But um, what you need to be paying attention to is high yield. Very important. Now, if you're on TradingView, you can just look at this. You could type in HYG, and then you can click the plus button and add SPY and just click a new price scale, and it will add it on a secondary price scale, and you can look at these on top of each other. The only problem with this is that high yield is being shown incorrectly in comparison to SPY because you're not accounting for the appreciation due to dividends and reinvesting. So what we do with this is we adjust data for dividends. So by going into the settings in the top under chart properties, under symbol, we can go adjust data for dividends, and boom, all of a sudden you see something that almost looks like SPY. Now, if you notice, every equity bottom coincides with a high yield bottom. Every time the equity or S&P bottoms, high yield bottoms as well. Now, um, there's many reasons for this, but I think it's the easiest way to explain it to someone that's new and that's listening is if you break equity, obviously bonds are traded above equities, right? Now, equities have different risk ratings, right? There's different grades of equities. There's ETFs and then there's individual companies and there's penny stocks, right? There's different classifications of risk. But in general, equities are under bonds in the or in the risk structure, right? So if you look at it from a risk structure perspective, you have treasuries, uh, and this all depends on the ratings, right? So you have municipals, then corporates, and then junk. But depending on the rating of the municipality, and the investment grade, you obviously could be shifted around. Long story short, high grade or junk bonds is the lowest before you go under equities. Now, obviously, there's some equities that are graded higher than high yield, but you understand just for the base of discussion here, the structure of the bonds is why high yield will trade more like equities than anything else because it's the things that has the highest risk within the bond section or in the fixed income section, if that makes sense. It's the closest thing to equity risk. So if we adjust high yield for dividends and we look at it, as you can see, high yield hasn't broken its prior peak. So high yield has been downtrending. It actually peaked when the SPY peaked in December, and it's been downtrending ever since. But it hasn't taken out. So its prior bounce high was 82.5, right? 82.6. Now this isn't like complicated technical analysis. I'm not, this is not no we're not doing no ocean beach Fibonacci's or whatever the spirals they're doing these days. We're literally just looking at um the movement of high yield in correlation to SPY. So high yield seems to be breaking down. We'll see how this plays out next week or this week, I should say. But with SPY moving up like this and high yield moving down, what bulls need to see, those people that had the fortitude at the lows to get long, or even some that got long in the last week and a half, you need to see high yield turn around and move higher. If high yield makes a new low, the odds, or if high yield breaks down from here and goes towards the lows and actually breaks, the 80 mark, the odds of SPY breaking lows is very, very high. If high yield breaks down and SPY is somewhat chopping sideways, I would actually play. There's an arbitrage play to be taken here where you long high yield and you short SPY because that will collapse on itself over time. Now, another important thing to look at on a high yield perspective while we're on this is the current yield on high yield is 4.29%. And if you take TIPS, which are Treasury inflation protection, right? So they're treasuries and they're linked. They're basically they're inflation protection, right? So they have a market that bids the inflation protection on the bond. That's how this works. People are willing to pay X price for inflation protection. Um, Obviously, the yield or the price of the bond goes down as inflation goes up. Yield goes higher. So the yield on a tip is 4.96%, which makes no sense, right? You're getting higher yield on treasuries than you are on high yield. So something's going to happen here. I don't know if tip is going to go higher, which would mean real yields go a lot lower and then high yield makes sense, or high yield goes a lot lower and yields more for tip. It's very interesting. But I think that The way that I think this plays out is real yields go up towards 0, high yield gets destroyed, and surpasses tip again because, it doesn't make sense for high yield to be yielding
Yeah,
less than
like,
tip.
it doesn't make sense to be taking on more risk
Right.
and yielding less.
Right. So I think that the high yield is gonna or break down. I think that there's more downside in high yield. And in turn, um, it's gonna overtake the yield on tips. That's where I think that's what it's gonna do. And real yields are gonna go higher. So I think generally what's gonna happen is tip and high yield are gonna continue to grind lower. I don't think the low and high yield is in. If it's in, we'll obviously see it this turnaround. But remember, I mean, we'll add we'll add SPY back on quickly just to run through this. Most of the time, they turn around together. It's actually quite interesting. If you like, we'll look back at the COVID, like they move in tandem. It's very interesting. So as SPY breaks higher, so is high yields, and we can go back to any real drop. It's quite. If you have some free time, you might want to do this because it's quite fascinating. The fact high yield is moving lower here is a very big red flag. I would,
Yeah,
I
there's
would
it's they move so much in tandem that there's literally an arbitrage opportunity
yeah.
if they
There's
don't
literally
move in tandem.
Yeah, if this breaks down further, there's an arbitrage opportunity, and you could play that by going outright equity, long high yield, short SPY equal weights on equal dollar size on both sides, or you could take an equal weight option play. You buy calls on high yield and you buy puts on SPY, but you have to be careful because you have to match the IVs are going to be different. It's a lot harder with just equity. It's easier to do where you can go long and short both sides, but yeah, I think that that covers a lot of this up. Do you wanna run over something before we wrap it
No,
up here?
I think that's a good spot to wrap it up for this week.
Yeah. Okay.
Well,
All right. Well,
thanks for
for
listening, guys.
yeah, yeah, thank you so much, guys. For those new to this podcast or just finding it, um, our market models that we talk about in the podcast, they're all free to public. We have market analytics and a bunch of data that we publish through our data feeds every day. It's all free. It's at www.market-radar.com. On there, you can find a link to our Discord, which is also free. And if you're interested in DDAP, there is a link on the website to access that as well.